covered bond. So covered bond is kind of, a very secured bond. Okay, that's why it is called covered bond. Covered in terms of risk, so it's very secure. Now, why is it called so? You think about a bank or else a non-banking financial company which is issuing home loans. Now, this bank has the asset of, let's say, you know, uh, let's say around 100 million. So this is through home loan. Okay, these are through home loan they have given, so which will come as their assets. So for 100 million, so this 100 million home loan assets will generate cash flows. Now this company wants to raise additional capital through bonds. Now they are issuing covered bonds. Now what do you mean by this covered bonds? So when they want to raise additional capital, say for example, see, let's say this is home loan is 1000 million. Home loan is 1000 million, and they want to raise this covered bond for 200 million. So when they want to raise this covered bond for 200 million, how will they pay? They will pay from these cash flows. Okay, so when they receive interest from this payment, that will be routed back to these bondholders. Okay, so that's the first mechanism about how these bondholders will get the cash flow. The second mechanism for them for the safety is, out of this 1000 million home loan, 200 million will be segregated. Okay, and 200, say, kind of most creditworthy borrowers home loan will be segregated, and that will be kept exclusively for these covered bonds, so that in case in future if something happens to the bank, also if this company goes bankrupt as well, so that these covered bondholders will not face any problem, because these assets have been exclusively kept aside for these bondholders. So payment can be made from these bondholders, and these will all be from the most creditworthy borrowers. And let's say worst to worst case, out of this 10 million uh, defaulted, so in that case also they will put back this 10 million again into the larger pool, and then they will take back again 10 million good pool, or 10 million good borrowers home loan from the larger pool. So all in all, this 200 million will always be of good creditworthy borrowers, and so these covered bonds are highly secure. That's why they have dual recourse. So dual recourse mechanism, as in, like, first one is they will get the payment from this larger pool, and also the second one is there will be one separate pool segregated for them, so that so that the bank, even in the worst case, that if the bank goes bankrupt, these covered bondholders do not get impacted. Okay, if these covered bondholders will not get impacted. Okay, so that's why it is called covered bond. Thank you.